When we talk about the general mortgage knowledge portion of the SAFE exam, we are primarily talking about a variety of mortgage loans and the terms associated with how to qualify for those loans. So let's first discuss conventional loans. Conventional loans are loans that are not insured or guaranteed by the government. Usually, first-time home buyers who qualify for a conventional loan may put 3% down on a home, whereas other buyers of conventional loans are required to put down 5%. Remember, a first-time home buyer is someone who has not owned a home or had ownership interest in a property for 3 years. Now, these down payment funds, whether it's a 3% down payment or a 5% down payment, it's important that you understand that 95% of the down payment must come from the borrower's own funds. The other 5% of the down payment may be a gift, and there must be supporting documentation stating that the person who gave that gift is not expecting the funds to be paid back. Conventional loans have what is called a due on sale clause, and this clause requires that the remaining balance of the loan be paid at the time of the transfer of property title before the new buyer can take ownership. It's important that you understand that because of this due on sale clause, this is what makes conventional loans not assumable. Now, I used the example earlier about my personal experience being a homeowner with a conventional loan. And I mentioned that because I did not have a 20% down payment, I had to pay what is known as private mortgage insurance. Now, we can remember that conventional mortgages have private mortgage insurance by remembering a mnemonic device that really helped me on the exam. And it goes like this. If we're talking about conventional people, we talk about people who do what is typical. And typically, people keep things private. Hence, conventional people are private people. So the words conventional and private go together. Now, before we move on to other types of loan products, I do want you to make note that the Federal National Mortgage Association, most often referred to as Fannie Mae, is the largest institutional buyer of conventional mortgages in the secondary market. Freddie Mac and Ginnie Mae are also two other entities that we will be discussing in future modules. Quickly note that the primary mortgage market is where mortgages are originated, so borrowers go to lenders in order to obtain home loans. The secondary mortgage market, however, is where the lenders sell mortgages to investors. We'll talk more about Fannie Mae as well as the secondary market in more detail a little bit later, but for now, it's important that you understand that there are two types of conventional loans: conforming conventional loans and non-conforming conventional loans. Conforming conventional loans are loans that must conform or adhere to the underwriting guidelines, loan limits, debt-to-income ratios, and down payment requirements that are set according to Fannie Mae and Freddie Mac. For example, you'll need to know that the debt-to-income ratio for a conforming conventional loan is 28% on the front end and 36% on the back end. Quickly, I want to clarify what a front-end ratio and back-end ratio is comprised of, because we will be seeing more of these ratios when we talk about other types of mortgages. The front-end ratio, also known as the housing expense ratio, measures what percentage of a person's gross monthly income is going towards housing expenses. Some examples of housing expenses include principal, interest, taxes, and hazard, flood, and mortgage insurance, also known as PITI, but I'll be referring to it as PITI. The monthly pity is divided by the person's gross monthly income in order to determine their front-end housing ratio. For example, let's say that Sally earns $2,500 gross monthly income, and her pity is $800 monthly. We would divide 800 by 2,500, which would equal 0.32 or 32%. So Sally's front-end ratio would be 32%. The back-end ratio, also known as the total obligation ratio, measures what percentage a person's gross monthly income is contributed to all debt that would be reported on a credit report, including the housing expenses. So some examples of other debt could be, but are not limited to, child support, student loans, alimony, car payment, boat payment, credit cards, personal loans, and any other legal obligations. Things like a cable bill, piano lessons, or an electric bill would not be included in this calculation. Now, please remember that any debt that has 10 payments or less left on it is not counted for this ratio. And one other note here. If a question on the SAFE exam talks about an auto lease, you must always count it in the ratio regardless of how many payments are left. Be sure you read the question carefully to know if they are talking about a car loan or a car lease. Now, using our example of Sally again, we've already calculated her front-end ratio. So now let's calculate her back-end ratio. Let's say that Sally has 2 credit cards and a car payment, and all 3 of those together equals $550 per month. And her monthly housing expenses are $800 per month. And again, her gross monthly income is $2,500 per month. We would add $800 plus $550, which would then equal $1,350. Then we would divide $1,350 by her gross monthly income of $2,500, reaching a back-end ratio of 0.54 or 54%. So in this example, Sally's front-end ratio would be 32% and her back-end ratio would be 54%. Since the ratio required for a conforming conventional loan is 28% front-end and 36% back-end, Sally would not qualify for a conforming conventional loan. Now let's do an example that you may see on the exam. Brent has a gross monthly income of $3,800. He pays $300 in child support, $350 on his car payment that will be paid off in 7 months, $150 for water, sewer, and trash, $35 for a cable bill, $75 on a credit card, and is seeking a mortgage with a pity of $980. What is Brent's housing expense ratio and total obligation ratio? Okay, I know that when we look at this example, we can already see that there is so much information in this question, and a lot of it we don't need. So our first step here is determining what information we need versus what information we're not going to use. Remember, we need to look at what the question is asking. So the question is asking for the front end and back end ratio for Brent. Now let's begin with the front end ratio. How do we calculate the front end ratio? Remember, we divide the pity by Brent's gross monthly income. So we would take $980 divided by $3,800, which leaves us with 0.257 or 25.7%, which we can round up to 26%. Now, the back end can be a bit tricky because we have some information that we don't need to include here. So let's look back at the question and determine what information we need and what information we don't need to use. Well, we know that the $300 that he pays in monthly child support is a legal obligation, so we know that this would be included in the total obligation ratio. His car payment would normally be included, except this question states that the car would be paid off in 7 months. So for this question, it will not be calculated in the ratio because it has less than 10 payments left until it's paid off. So we ignore the car payment. The $35 cable bill and the $150 for water, sewer, and trash, they are utility bills as well as a voluntary bill. So these are not considered to be debt. Remember, the purpose of this ratio is to calculate the debt to income. So we can ignore the cable bill and the water, sewer, and trash bill. So that leaves us with a $75 monthly credit card payment and a $300 monthly child support obligation, along with the $980 pity. So we would add $980 plus $75 plus $300, which would equal $1,355. We then would take the $1,355 and divide it by the gross monthly income of $3,800, which equals 0.356, or 35.6%, which we can round up to 36%. Therefore, the answer to this question as to what Brent's front-end and back-end ratio is 26% front-end and 36% back-end. So now that we understand what conforming conventional loans are and have also gotten a taste as to how the math on these ratios work, we can safely conclude that when we talk about non-conforming conventional loans, we're talking about the types of loans that do not meet the underwriting guidelines, loan limits, debt-to-income ratios, or down payment requirements that are set by Fannie Mae and Freddie Mac. Keep in mind, non-conforming loans cannot be sold on the secondary market. There are 3 types of non-conforming conventional loans that are important you understand for the SAFE exam, and those are known as jumbo loans, subprime loans, and Alt-A loans. Jumbo loans exceed or are greater than the loan limits that are set by Fannie Mae and Freddie Mac. Subprime loans are the riskiest type of loans and are associated with borrowers who have poor credit scores or derogatory marks on their credit reports. And finally, Alt-A loans is a classification of mortgages with a risk profile falling between prime and subprime credit quality. So, just as a review, conventional loans are loans that are not insured by the government and have a due on sale clause, meaning they are not assumable. They have a required 3% down payment for first-time home buyers and a 5% down payment for any other buyer. And the buyer must pay private mortgage insurance if the borrower puts less than 20% down on the home. There are 2 types of conventional loans, known as conforming conventional loans and non-conforming conventional loans. The conforming conventional loan is a loan that conforms to the debt-to-income requirements, underwriting guidelines, loan limits, and down payment requirements that are set according to Fannie Mae and Freddie Mac, and they may be sold on the secondary market. Non-conforming conventional loans are loans that do not adhere to the guidelines and specifications of Fannie Mae or Freddie Mac, and there are 3 types of non-conforming conventional loans known as jumbo loans, subprime loans, and Alt-A loans. Remember, when we talk about the secondary market, we are talking about mortgages that may be sold to investors. Quickly, I want to go over 2 types of funding that investors may use to fund the purchase of these properties on the secondary market. Table funding allows a broker to originate and close a property under their own name, but once the loan is closed, the mortgage and the note are immediately assigned to the investor. The way that I remember that table funding works this way is if you're sitting at a table with your friends at a bar, but you forgot your ID, so you can't buy a drink. But your friend at the table goes to the bar, shows their ID to buy your drink, and then comes back to the table to give it to you. You may Cash App them or Venmo them later, but this concept is very similar to what we mean when we talk about table funding and is also a good mnemonic device to remember for the exam. Warehouse funding, however, is another type of funding that investors use, which is where a lender receives funds from a line of credit from a commercial bank. And I always remembered that warehouse funding always includes a line of credit, because when you think about a warehouse, there's always an assembly line of things that need to be done in order to make something. So that's how I remembered that warehouse funding always includes a line of credit.